Good evening, my name is Angela and I'm here to present the Form 1065 with the K1 partnership and the Form 1120S with the K1 for the shareholders. Okay, we are doing it based on Good to Eat. It's a bakery that was opened by James and Paul doing custom professional cakes. They each contributed $50,000 in exchange for 50% ownership of the company. They borrowed $200,000 from a local bank in which they both guaranteed that loan. They are a cash method of accounting and reports their income based on the calendar year basis. We have $450,000 of revenue in their first year with $210,000 of cost of goods sold. At the end of the year, there was no inventory to report. They were each paid, James and Paul were each paid $30,000 compensation, as well as $40,000 in compensation was paid to the other employees. They did have expenses for rent and equipment, advertising, interest expense, utilities, and supplies. They also were kind in their first year and gave money to a charity. They did have $1,000 of qualified dividends from a stock investment, as well as a $1,500 short-term capital gain when they sold some stock. They had $200,000 in distributions given to each of them at the end of the year. And then they also had some qualified property worth $300,000. Okay, we're going to go over the 1065 partnership. Okay, this is going to be the first page of our 1065. Okay, you're going to see this is the top portion of the partnership tax return. Top part has all of the partnership information. This is their initial return. Then you will see we have our partnership income. They had $450,000 of gross receipts, $210,000 of cost of sales, which gave their cost of goods sold, which gave them a profit of $240,000. Okay, then we have salaries of the employees, which was the $40,000. Then we also have the guaranteed payments to the partners of $60,000. That is the compensation they received. We have $15,000 in rent, $14,000 of interest expense, and then we have $26,000 of other deductions, which would be the advertising, supplies, utilities, which gives them a total of $155,000 in deductions. You take their income and deductions, you subtract them out, you come up with $85,000 in ordinary business income. Okay, this is going to be the Schedule K. This is what's going to give us the information needed to do our partnership K1s. Okay, right here you will notice that we have the ordinary business income, and then we have the $60,000 in guaranteed payments. We have the $1,000 of ordinary and qualified dividends. We have $1,500 in short-term capital gains. Okay, we have $5,000 of charitable deductions. The net earnings for self-employment is going to be $85,000. And then we have the distributions of $40,000, which was the $20,000 to each partner. Okay, here we have our balance sheet per the books. They did not have beginning books as this is their first year. So our ending cash at the end of the year is going to be $42,500. We have $300,000 of building or other depreciable assets with no depreciation, being as how this was the first year. Therefore, the total assets is $342,500. Down here we have our under liabilities and capital. We have the loan that they took out at the beginning of the year that is payable in 1 or more years, so it's $200,000. The partner's capital account is $142,500. Therefore, giving a total liability and capital of $242,500. If you notice, the total assets and the total liabilities and capital, they both match. Therefore, our books are in balance. Okay, we have our M1 and M2. M1 is the reconciliation of the income per the books. You'll see the net income per the books is $82,500. Guaranteed payments of $60,000. If you add those lines up, we get $142,500. There was nothing that needed to be deducted that wasn't deducted already, therefore leaving the income at $142,500. Then we want to do on our M2 the analysis of the partner's capital. You will see at the beginning of the year, again, it was zero. They each contributed $50,000, giving us $100,000 in cash. The net income from the company was $82,500. Add those lines together, we get $182,500. We did give out that $20,000 each, totaling $40,000 in compensation, in distribution. If you take that away, that comes to $142,500, which again matches up with the income, so we are again in balance. Now we have our partnership K1. If you will notice, this is going to be half of the numbers from the Schedule K, as each partner is a 50-50 partner. So we are only going to do Paul's K1, as James's will be the exact same. So again, the beginning of the year capital account had zero. There is a $50,000 that was contributed on his part this year. Half of the year's net income is $41,250. He did take out a $20,000 distribution, ending his capital account with $171,250. The extra $100 came from the $200,000 loan that was taken out at the beginning of the year. Okay, now we are going to go over the 1120S. This is for a sub-chapter corporation. Okay, here is the first page of the 1120S. Again, most of this will be pretty much the same as our partnership with just a few differences. As you can tell, all of the income is all still the same. It all looks the same as it did on the partnership. The deductions is where things come a little different. Instead of being guaranteed payments, we have compensation of the officers, which is $60,000, $40,000 to its employees. Then we have the $15,000 rent, the $14,000 interest, $20,000 in advertising, which on the other partnership tax return, we had that as other deductions. So in the other deductions for this will be the utilities and supplies of $6,000, which gives a total deduction of $155,000 with an ordinary business income of $85,000, same as it was on the partnership. This is our Schedule K, which again will give us the information that we need in order to do our K1 for each of the shareholders. Okay, the income, $85,000 for the ordinary business income, $1,000 for qualified and ordinary dividends. We have a $1,500 short-term capital gain. We have a $5,000 charitable contribution. Okay, then we will go to the balance sheet. And again, this is going to look just like it did on the partnership tax return. It's all completely the same. Okay, your M1, again, we had net income of $82,500. We don't have any income or expenses that were recorded on the books, but not on the K1. There was no travel or entertainment. Therefore, when you add those lines together, you still come up with $82,500. And there was no income recorded on the books this year that is not on the Schedule K, with the same as the deductions. Therefore, the income is still $82,500. On the M2, the analysis of the accumulated adjustments on the account for the shareholders, you will again see that it started out with zero. Our ordinary income was $85,000. We had $2,500 in additions. We had a reduction of $5,000, which was the charitable contribution. When you combine these lines all together, you come up with $82,500. Take out the distribution of $4,000, and the tax balance at the end of the year is $42,500. This is our K1 for the shareholders. It's all going to be pretty much the same as it was for the partnership. There's just a couple of differences, whereas instead of having the block for the capital accounts, we don't have that on the shareholders K1s. But other than that, everything is still pretty much the same. So if you have any questions, please let me know. Otherwise, please let me know if there's anything else I can do for you. Thank you.